Hi, everyone. Welcome back to our podcast, The Ins and Outs of Selling a Business. For those of you just joining us, my name is kdee. I'm president of Osage Advisors. Osage Advisors is a boutique merger and acquisition firm working with business owners and their families looking to sell, typically with revenues of $5 million and up. We've been around. This is our 22nd year, and thanks for joining us. Today's topic is one that, I kicked around a lot because it's not everybody's favorite topic. It's taxes. But taxes is one of the most critical components of an M&A transaction. So I thought it was very important for us to talk about it a bit today. Tax strategies, ways to minimize tax, ways to eliminate tax, ways to defer tax. So I'm very happy to welcome our guest, Steve Holt. Steve is a partner with the firm of Mandelbaum Barrett. Mandelbaum is a long-term law firm based in northern New Jersey with offices in New York City. They have been named to the U.S. News and World Report's to their best law firms list for several years, including 2022. Steve has over 35 years of experience. He chairs the firm's taxation, trust, estates, and charitable organizations departments, and has specific knowledge, which is relevant for today's topics, regarding sophisticated family wealth transfer planning, business succession planning, and has been involved in multiple M&A transactions, both sell and buy side, over the years. Steve, I appreciate your time. Thanks for joining us.
Keith, thank you for having me. It's certainly my pleasure. I hope to impart some helpful knowledge to your potential business sellers. One key item is to remember that this planning works best if you think about it well ahead of a sale. We struggle with the potential tax savings and opportunities where you get a little too close. So the time to start thinking about succession planning, transition planning, income tax, and estate tax savings in the context of a business sale is when the thought of the sale first enters your mind and gets serious, rather than after the letter of intent stage, and certainly well ahead of the contract stage. If I might, Keith, I want to talk about a couple of very strategic, beneficial opportunities that we can present to business sellers. And just by way of background, it's important to understand that the estate tax rate is a very substantial rate. It's 40%. It's pretty much a flat tax for large transfers of wealth. That's a big bite when you think about the fact that you've built a business, paid a lot of income tax along the way, struggled to manage cash flow, and you're trying to get your payout at the last day, only to have a 40% haircut. The good news is that there are a lot of opportunities for pre-sale planning that can substantially reduce your tax bite, as well as increase the flow of funds for your own benefit and the benefit of your family after the sale transaction. So I'm going to talk about a few, I think, very strategic planning techniques for business owners that will allow for the saving of estate tax primarily. The other side of the coin is income tax savings. The federal government has structured the tax code in such a fashion that when you sell your business, other than by doing a reorganization where you receive shares of the buyer, for example, you're going to pay the federal tax. There's really not much that can be done about that. The good news is that the federal estate tax rate for capital gain transactions is a high of 20% today. So if you structure the transaction correctly so that the assets being sold are capital assets, it's primarily the goodwill of the business or the shares of the business itself, you're going to enjoy a 20% haircut plus the state income tax, which isn't terrible when you think about the ordinary income rates, which are nearly double that. There's a technique that I'll introduce that'll help you think about potential income tax savings. It doesn't always jive consistently with your estate plan, so you kind of have to pick your poison, if you would. Let's talk about the estate tax first. there are a number of ways to transfer assets ahead of a sale, which can maximize your estate tax savings through the use of careful planning in terms of timing, as well as valuation strategies. If you're thinking about a business sale, your business and there's no offers on the table. We all know that a strategic offer from a strategic buyer is going to be a larger number than you think your business is worth on a going concern basis. And that's very important. If you were to bring in a valuation professional to value your business as a private company, for a host of reasons, that valuation would most likely not reflect the strategic value. It's a non-saleable asset. If you have multiple owners, there are questions of the ability to liquidate the business. What is the liquidation value as compared to the strategic value in the hands of a strategic buyer? All of those variables substantially reduce the value. It's important that you get a qualified appraisal. Your appraiser will take into consideration the fact that the business is private. There's no public market for the sales. Owners of the shares are locked into the business, normally by reason of buy-sell agreements or operating agreements. If you're an LLC, there's limited ability to liquidate your interest. And accordingly, when you look at those interests on a standalone basis, they're worth a lot less than their relative share of the strategic value. So you want to get to start the process, you want to look at the value. You want to make sure that the valuation reflects all of these value diminution variables, and then you can start thinking about transfers. A lot of our clients have built their businesses, and it's the payday time, but they're worried about cash flow. If I were to simply give away my interest to my children or trust for my children, where does that leave me? In many cases, they have great concerns about where they're going to be left following a sale and how they can manage their retirements. There's a technique that has been developed and we use very extensively to obviate that concern for business owners. It's called a spousal lifetime access trust. This is a trust that the business owner would create, which provides benefits for his spouse and, if he wishes, children, grandchildren, other beneficiaries. The key component there is that there is the includability of the spouse as a beneficiary, so that if the business owner were to transfer his business to a SLAT, it's called the SLAT, Spousal Lifetime Access Trust, he still has access to the cash flow from the business proceeds by reason of the fact that his spouse is a permissible beneficiary. In many instances, the spouse will actually be the trustee and so controls how the assets are distributed out and when. In addition, the business owner, who's been used to maintaining control over his assets, can be appointed as the investment advisor to the trust and thereby allowed to manage the assets and how they are invested without being a beneficiary and without causing the assets to come back into his estate. So we did, over the last couple of years, as there was this potential for a fiscal cliff, which would have reduced the estate tax exemption amount significantly. We did a number of SLATs to the very pleasure of our business owners. There are limitations. You can only give away 24 million of assets during your lifetime without incurring a federal gift tax. So unless it's strategically beneficial to pay a gift tax, you would normally not want to transfer more than your exemption amount into a trust of this nature. Again, the key is that the trust is flexible in terms of benefits that can be paid for your family. It allows for distributions back to your spouse so that you can enjoy the cash flow from your assets, and otherwise provides very flexible planning for your family. If cash flow preservation is not that significant in importance, the other strategy is to use your exemption amount, again, your $24 million exemption amount for a married couple, to make gifts, again, in trust for your children, your grandchildren, other beneficiaries. It's important to note that when we set up trusts for children and grandchildren, we normally recommend that they be lifetime trusts for two reasons. Number one, the assets are protected from your child's creditors, provided there's an independent trustee that can serve with or without your child. Secondly, at your child's death, whatever the value of the assets has grown to during his or her lifetime is completely exempt from federal and state estate taxes. Again, there's a limitation. These types of trusts can only receive up to $24 million of assets without a gift tax. That's normally where our clients tend to stop when they're doing transfer planning because nobody wants to pay a tax too early. There are kind of two ways to look at it. Do I want to benefit my children and grandchildren in a trust where I don't need the funds? Or secondarily, do I need the funds and therefore will I use the SLAT strategy? The third approach, which a lot of our clients have an appetite for and many don't, is to use certain charitable trusts to hold assets of your family business ahead of a sale. If you have a charitable interest, there's a great deal of benefit there. Primarily, when the business assets are sold, the gain is completely eliminated, federal and state level, because the trust is a charitable trust. Charitable trusts do not pay income tax on income or gains. It's a great way to do your charitable planning and at the same time significantly reduce your income tax liability on the sale, as well as your estate tax on your accumulated wealth. Any assets held in the trust are not subject to estate taxes. If in the case where the business owner feels he still needs some access to the cash flow from the sold asset, you can set up what's called a charitable remainder trust. A charitable remainder trust provides for a distribution for a number of years or for the life of the grantor of the trust of a certain amount, to assure that the grantor business owner still has cash flow for a significant period of time. And then following that annuity period, the asset devolves down to designated charities. With this type of trust, to the extent of the actuarially determined value of the remainder interest that will ultimately pass to the charity, the business owner gets an income tax deduction for the transfer into the trust, as well as a gift tax deduction to the extent of the value of the remainder interest. If the business owner wants to generate cash flow for a charity and ultimately have the residual value of the asset that he sold go to his family, he would set up a charitable lead trust. This type of trust pays an annuity interest to the charity during a period of time, after which the asset passes to his children, grandchildren, or anyone else he wishes to benefit. So again, charitable planning is a great tool to be used by a business owner, again, ahead of a sale, because we want to get these valuation plays at work. If you have a charitable interest, many of our clients don't, and the numbers may not justify building charitable planning into the structure, but it's something that certainly can be accommodated, again, ahead of a business sale.
So Steve,
Keith, any questions on that component?
Yeah, there's so that's what I'm hearing from you. There's several techniques that will provide the cash flow, because a big question for most of our clients and your clients is, will I have enough money post-sale to live the life I'm accustomed to, right? I don't want to short myself or my family. I also don't want to shift a huge portion of the proceeds of sale to whether it be federal or state taxes. And it's all about cash flow post-sale. And, we're trying to avoid surprises, right? I mean, the key thing about planning is that you don't, you want to limit it to surprises in a transaction. So if a business owner is not thinking about this, hasn't engaged with the right trusted advisors like yourself or me, and all of a sudden he gets to the table after spending a lot of money and he realizes he has a huge tax liability, he may walk away because, hey, I can't do this because there's no money left for me or not enough left for me and my family. So what I'm hearing from you is, and of course, what's happening here is that you have, it's a family. So the second generation or third generation is thinking about, well, I'm just going to take the business over. My parents are going to give me the stock and their parents are saying, well, what am I going to live off of? Right. So what I'm hearing from you, and these are favorable elements of the tax code that could be implemented so that our clients, yours and mine and others watching, can live the life they want to, but also minimize the tax implications of a transaction. So I guess what it comes down to is when you sit with your client, right, or a client, hopefully way ahead of the game, right? What are the kind of questions that you prod them, ask them, because they're not thinking about this daily, right? They're not thinking about, all right, my charitable, I give to the church, I give to the town, I give to the land trust, whatever their passion is on a charitable perspective. And I got my kids, and now I got my grandkids. Should I, frankly, some of the tax planning techniques I've asked my clients about is, well, I'm just going to move to a tax-friendly state, right? But is that what you really want to do? I mean, you got your kids, your grandkids, maybe you have an older parent, you want to be close to them, and then all of a sudden you're out of, you're someplace down south or west for 6 months and a day before you can come back. So I'm interested. I think the audience is like, the kind of things that you're trying to, kind of get where they're coming from, right? What are their goals? What are their objectives? How do you go about that in your conversations? Because these are complex. I mean, your stuff. You've been doing this for years. You have a great tax department at Mandelbaum that lives and breathes this daily. But to bring these concepts in front of a business, how do you guys approach that?
Sure, good, very good question. One of the key components that is overlooked in the planning process with professionals helping you sell a business is the family dynamics. What are you going to do that will break your sales proceeds into 3 or more components, those being what you have, what your children have, and then, if applicable, what a charity will get. Our clients are very fearful about enriching their children. The phenomenon that we try to move clients away from, and it's hard to do, is the secrecy. The adult children don't know anything about the business. They don't know the value. They can't plan for their own lifestyles. They don't know what the end game looks like because dad's concerned about spoiling them, enriching them unnecessarily. That's where the magic of trusts come in. Right.
And these are kids. I'm sorry. These are children who probably don't work in the business, correct? Or could work.
That's the other nuance, right, that certainly creates a lot of challenges for you and I, Keith. Mm-hmm. As you know, what do you do about the children that are in the business versus the children that are outside of the business? What we see often is the buyer recognizes the value of the working child, wants them to stay on board, wants to enrich them with nice compensation, incentives, opportunities on the long term. Where does that leave the other children who are outside of the business? We spend a lot of time talking to our clients about that topic. Do we do something extra for the kids who are outside of the business? Do they deserve that? Is there enough available for them? How do we augment it if you feel compelled to enrich your son or daughter who's helped you build a business where the other children might feel they've been shorted? There's a lot of strategies that we build in, including life insurance to make equalization transfers. But we're psychologists in a way, Keith. Right. We have to deal with the emotion of all of that, and oftentimes, this is the first time that children are exposed to any knowledge about the business, what it's worth, what it means to them, and what will that do to change their lifestyles, if at all. And it's a shock and it's emotional. And then you have brother or sister who's, suddenly going to get a great employment contract and a long-term security package while they are not sure of where they're going to end up and what they have to do on a career path. So it's a conversation we have most often with the family, with the senior members of the family, rarely with the kids, but as other professionals will attest to, it's so important to get them into the mix early on. The key is the use of trusts, of course. When you say to a child, you're going to be the beneficiary of a $20 million stake in this business, right away they're running to buy the boat or the motorcycle. Well, that's not how it's going to work, because your share is going to be held in a trust. We always recommend that the child have a seat at the table, so that even though they may not be their own trustee, they're sitting with the professional trustee, looking at investments, talking about cash flow, talking about their needs, being conservative in what they want, knowing that this is an opportunity for a lifestyle change, but not now. Now
Right.
you have to be productive. Now you have to think about, your career path, and then maybe this will give you an opportunity for an early retirement, or even an opportunity to enrich your own children, all in a very tax-favored environment. But those are challenging conversations, as you and I have both had.
Yeah, it's as I sometimes say, when the transaction becomes public among the family, all of a sudden it gets people's attention, right? They know there's money there, and how do the parents navigate that? And it's complex. It may not be just it could be a second marriage, right? There could be stepkids. There could be a lot of different avenues that need to be addressed. That puts a lot of pressure on the business owner, because they kind of have been avoiding it for a long time. They're probably thinking about it, but it kind of like just I don't want to deal with this right now, right? I'm trying to run my business, and but then it comes to a point where it becomes real. And all of a sudden, you're at the table over Thanksgiving, or just a meal with a couple of your kids, your grandkids, your stepkids, and it can be uncomfortable, right?
Correct.
So I think that's an interesting area, and I would love to have you back and talk a little bit more about that family dynamic piece, because you're hitting on a critical issue. That's, and in fact, a lot of people, may delay the sale of their business because they don't want to deal with that aspect of it, to a point to the detriment of the company and themselves, right? From a stress perspective, from a health perspective, from a numbers perspective. So I'd love to have you come back and talk a little bit about some of these family dynamic areas and other tax tools, tax strategies you use, and just spend some time talking about that. And that would be great if you could do that.
My pleasure, Keith. Absolutely. Thank you.
Well, great, Steve. Thanks for being with us. Again, my name is Keith D. I'm president of Osage Advisors. You can reach us at our website at osageadvisors.com. Feel free to email me at kdee@osageadvisors.com, or pick up the phone anytime and give us a call at 860-767-3273, extension 1001. Thanks for being here today, and have a great day.